You may not realize it yet, but something fundamental has shifted beneath the surface of the global financial system, and the consequences are far larger than most headlines are willing to admit. This is not a forecast. This is not theory. This is not a distant risk. A critical threshold has been crossed, and it starts in a place most people still believe is stable, controlled, and predictable: Japan. Right now, on December 31st, 2025, as we enter January 1st, 2026, Japan's 10-year government bond yield sits at approximately 2.08%, the highest level since 2006. The 20-year yield stands at 2.985%. The 30-year yield has reached 3.41%, an all-time record high. These are not just numbers. These are alarm bells ringing at a frequency most people cannot hear yet. The scale of the debt bomb. For decades, Japan has been treated as a financial constant, a quiet pillar holding up the global system through sheer scale, discipline, and central bank intervention. But what just happened there is not business as usual. The pin has been pulled, and the global debt system is now operating in a far more dangerous phase than at any point in recent history. At first glance, the developments in Japan's bond market may look technical, even boring, the kind of thing only economists and traders should care about. But this is exactly how systemic crises begin. Quietly, mathematically, and far away from public attention. Japan is not just another indebted country. It is the most indebted major economy on Earth, with a debt-to-GDP ratio hovering around 250%. Japan owes roughly 2.5 times the total value of everything its economy produces in an entire year. For context, the United States, often criticized for its debt excesses, sits near 120%. That number is already considered extreme by historical standards, yet Japan operates at more than double that level. This alone tells you something crucial. Japan has no margin for error. When interest rates move even slightly higher, the cost of servicing that debt explodes at a speed most people underestimate. Government debt servicing now consumes approximately 25% of Japan's entire budget. That's before the recent rate hikes fully filter through. On January 1st, 2026, the Bank of Japan made a decision that sent shockwaves through global markets, though most people missed it. The BOJ raised its benchmark interest rate by 25 basis points to 0.75%, the highest level since September 1995, a full 30-year high. The decision was unanimous, and critically, Governor Kazuo Ueda signaled that more rate hikes are coming if conditions continue to evolve as expected. This wasn't a hawkish surprise. This was a trapped institution being forced to choose between two impossible options. For years, Japan made its impossible math work through a single extraordinary mechanism: its own central bank. The Bank of Japan became the largest buyer of Japanese government bonds, effectively monetizing the debt and suppressing yields. The BOJ owns approximately 46.3% of all outstanding Japanese government bonds, nearly half the entire market. Investors didn't demand higher returns because they knew the central bank would step in, buy bonds regardless of price, and keep the system running. This was not a free market. It was a controlled environment, a financial pressure chamber designed to prevent volatility at all costs. And it worked, until it didn't. What changed is not a single announcement or policy headline, but a shift in expectations that the market can no longer ignore. Japan's new Prime Minister, Sanae Takaichi, has signaled aggressive fiscal stimulus at a time when inflation is already present and the yen is already weak. On November 22nd, 2025, her government announced a Y21.3 trillion stimulus package, approximately $135 billion, equivalent to 3.8% of GDP. The plan focuses on three pillars: supporting households amid inflation, boosting wages and consumption, strategic investments in technology and defense. On January 4th, Japan's cabinet approved a record Y122 trillion fiscal year 2026 budget, the largest in history. This combination is toxic for a country drowning in debt. More spending means more bonds. More bonds mean more supply. And more supply means investors will demand higher yields to compensate for growing risk. The market has already started pricing this in. Traders are openly betting that yields will continue to rise, a dynamic now known within financial circles as challenging the Bank of Japan's ability to control its own bond market. This is where the situation becomes genuinely dangerous. The Bank of Japan is trapped between two catastrophic choices. Option A: intervene aggressively, print more yen to buy bonds and cap yields. This risks accelerating the collapse of the currency. A weaker yen raises import costs, fuels inflation, already running above the BOJ's 2% target, and undermines confidence in the entire monetary system. Option B: step back and allow yields to rise in the name of market normalization. This makes servicing the massive debt load unsustainable. At debt levels this high, even a modest increase in interest rates can trigger a fiscal crisis. History is brutally consistent on this point. No nation, no currency, and no central bank has survived debt at these levels indefinitely without either defaulting outright or inflating the currency into irrelevance. The BOJ's December rate hike to 0.75% represents them trying to walk a tightrope between these two disasters. By raising rates slightly, they signal they're addressing inflation. But they can't raise too much, or the debt servicing costs explode. They're managing the collapse, not preventing it. The numbers tell the story of mounting pressure. Japan's 10-year bond yield surged approximately 89.9% in 2025 alone. The 30-year yield hit an all-time record high of 3.41%. December 22nd saw the 10-year yield spike to 2.1%, the highest since February 1999. This marks the steepest annual surge in Japanese government bond yields since 1994. On December 31st, just yesterday, yields moderated slightly as year-end profit-taking occurred, but the structural pressure remains. The 20-year yield closed at 2.985% and the 30-year at 3.41%. Analyst Robin Brooks recently published an urgent warning titled Debt Crisis in Japan, stating, "Long-term government bond yields have risen very sharply in Japan this year. Indeed, the 30-year yield is at its highest level ever." This is unprecedented territory for a country that built its entire financial model on the assumption of ultra-low stable rates. Why should Americans, Europeans, or anyone outside Japan care? Because Japan is not just a borrower. It is a cornerstone of global capital flows. Japan is the largest foreign holder of U.S. Treasury debt, sitting on approximately $1.2 trillion as of November 2025, the latest data available. This represents Japan's highest holdings since August 2022. For years, Japan continued buying U.S. debt even as other countries quietly reduced their exposure to the dollar. Why? Because Japanese bonds paid almost nothing, making U.S. treasuries, once hedged for currency risk, relatively attractive by comparison. That equation is now breaking down in real time. As Japanese yields rise, the incentive to keep capital parked in U.S. debt weakens dramatically. When you factor in the cost of hedging currency risk, which has been rising, the math no longer works. Japanese insurers, pension funds, and banks manage liabilities stretching decades into the future. They are being forced to reconsider where their money should be. Capital repatriation is no longer a theoretical risk. It is a rational response to changing conditions at home. A recent analysis from Seeking Alpha, titled Japanese Bonds, a 2026 wildcard, warns higher Japanese yields may prompt repatriation of capital by Japanese institutions, potentially driving up yields and causing volatility in U.S. treasuries. When capital flows reverse, they do not do so politely or slowly. They move with speed, scale, and force. This is the moment where a Japan problem becomes a global one. If demand for U.S. treasuries falls at a time when the United States is already running massive deficits, financing costs rise. Today, the interest expense on U.S. debt alone exceeds $1 trillion per year, more than the entire U.S. defense budget. That is before accounting for additional borrowing, higher interest rates, reduced foreign demand. The system is already strained. It doesn't need a shock, and yet that shock may already be underway. The U.S. government needs to sell trillions in new bonds every year just to roll over existing debt and finance current deficits. If the largest foreign buyer, Japan, slows or stops purchasing, yields must rise to attract other buyers. Higher yields mean more expensive mortgages for American home buyers, higher credit card interest rates, more costly business loans, larger federal budget deficits as debt servicing, crowds out other spending, potential forced austerity or money printing. What makes this situation even more fragile is that Japan's role in global finance extends far beyond government bonds. For decades, Japan has been the foundation of one of the largest and most invisible trades in the world, the yen carry trade. Here's how it works. Investors borrow cheaply in yen when rates were near zero, convert that capital and invest in higher yielding assets abroad, U.S. stocks, corporate bonds, real estate, emerging markets, even cryptocurrencies. The scale is staggering. Including derivatives and structured products, tens of trillions of dollars in global finance are linked directly or indirectly to yen-based funding. Recent estimates suggest the yen carry trade has ballooned to approximately $500 billion since 2011. The structure only works as long as borrowing costs remain near zero. The currency remains weak or stable. The moment either condition changes, leverage turns from a source of profit into a source of forced liquidation. We saw a preview of this in 2024. When the yen strengthened unexpectedly in July-August 2024, global markets reacted violently. Tech stocks sold off, volatility spiked, and confusion spread because the trigger was not obvious. It seemed to come out of nowhere, but it didn't. It came from the slow unraveling of a system built on assumptions that no longer hold. That episode passed not because the risk disappeared, but because the system was given more time. Time is now running out. A recent report from Investing, Com warned, the carry trade won't unwind overnight, but it's unwinding. And as funding costs rise and positioning adjusts, the assets that benefited most from cheap yen, tech stocks, leveraged credit, emerging markets will face the most pressure. The convergence of forces in late December 2025 created a perfect storm. BOJ rate hike to 0.75%, December 19th. 30-year high record, $122 trillion budget approved, December 25th. Bond yield surging, 10-year hit 2%, 30-year at all-time highs. Inflation persisting above BOJ's 2% target yen volatility, creating hedging cost uncertainty. Fiscal year 2026 begins April 1st. Massive new bond issuance coming. The Wall Street Journal published an article on December 8th titled, Japan is outspending. Bond markets seem nervous about picking up the tab. The concern is simple. Who will buy all these bonds? The BOJ has indicated it will slow its bond purchases starting in spring 2026. If the central bank steps back even slightly, private investors must step up. But private investors demand market rates, not suppressed rates. This is how yield control breaks down. For years, many believed Japan would never experience meaningful inflation again. That assumption is dead. Japan's inflation has been running above the BOJ's 2% target, driven by weak yen raising import costs, global energy prices, supply chain disruptions, wage negotiations gaining momentum. Prime Minister Takaichi's stimulus package, while politically popular, adds fuel to the inflationary fire. More government spending during a period of already present inflation is the textbook definition of pro-cyclical policy. Exactly what you shouldn't do. The BOJ is caught. They must raise rates to combat inflation, but raising rates makes the debt unsustainable. They must choose between currency, credibility, and fiscal solvency. There's no path that preserves both. When the most extreme debt experiment in modern history reaches its limits, the effects do not stay contained. They ripple outward through multiple channels. Channel 1, U.S. Treasury market. Reduced Japanese buying, higher U.S. yields, higher borrowing costs globally. Channel 2, currency markets. Yen strengthening triggers carry trade unwinds, global asset liquidation. Channel 3, credit markets. Higher risk-free rates, corporate bonds reprice, credit spreads widen. Channel 4, equity markets discount rates rise, growth stocks especially vulnerable, tech sector pressure. Channel 5, emerging markets. Capital flows reverse from EM back to developed markets, EM currency crises. Channel 6, real economy, higher financing costs, reduced investment, slower growth, recession risk. As we enter 2026, several critical dates loom. Q1 2026, January-March. BOJ policy meetings will be closely watched for further rate hike signals. Japanese institutional investors reset allocations for fiscal year. Starting April 1st, U.S. Treasury auctions face potential reduced demand April 1st, 2026. Japan's fiscal year 2026 begins. Massive new JGB issuance hits the market. Wind our $122 trillion budget. BOJ begins slowing bond purchases as previously announced. Throughout 2026, multiple BOJ rate hikes expected if inflation persists. Yen, carry trade, unwinding continues. Global bond market volatility likely increases. Analyst forecasts for Japan in 2026 are starkly divided. Optimists, GDP growth accelerates to 1.4% due to stimulus, primary balance, surplus achieved for first time in 28 years. Pessimists, debt spiral accelerates, bond market loses confidence, currency crisis emerges. The IMF has expressed concern about Japan's fiscal path. An IMF statement in early December noted they were encouraged that Japan skipped burdensome proposals in its fiscal package, but warned that with debt at more than twice the size of its economy, Japan is widely viewed as needing to fix its tattered public finances. Perhaps the most underestimated shift is psychological. For 30 years, Japan lived in a deflationary world where prices fell or stayed flat, cash was king, debt was cheap forever, bonds were risk-free. That entire framework is shattering. When the collective mindset shifts from deflation to inflation, from suppressed yields to market yields, behavior changes dramatically. Savers demand higher returns. Lenders price and currency risk. Investors rotate from bonds to real assets. Wage negotiations intensify. Government loses fiscal flexibility. Once this psychological shift takes hold, it feeds on itself. Inflation expectations become self-fulfilling. Bond yields must rise further to compensate. The debt trap tightens. What many miss is that this is not just a debt crisis or a bond crisis. This is the early stage of a currency event. When debt reaches levels that can no longer be serviced without debasement, confidence in the currency itself comes into question. Japan faces this reality first because it went furthest down the path of debt monetization, but Japan is not alone. The same dynamics threaten. United States, 120% debt to GDP rising. European nations, varying levels, many above 100%. United Kingdom, 100% plus debt to GDP. The global monetary system is built on confidence in fiat currencies backed by government bonds. When the bonds of major economies become unstable, the currencies built on those bonds lose credibility. This is why gold has surged in 2025. This is why Bitcoin rallied. This is why real estate remains bid despite high mortgage rates. Capital is seeking refuge outside the traditional debt currency system. So what does this mean for investors, savers, and anyone trying to navigate 2026? 1. The bond market paradigm has shifted. The 40-year bull market in bonds is over. The era of bonds are safe is ending. Yields will be more volatile, and duration risk, sensitivity to rate changes, is back. 2. Currency risk is real. Don't assume major currencies are stable. Diversification across currencies and into hard assets makes sense. 3. Debt is no longer cheap. Businesses and individuals operating with high leverage face refinancing risk as rates rise. 4. Japan is the canary watch. Japanese bond yields, BOJ policy, and yen carry trade indicators. They are leading indicators for global stress. 5. Physical assets gain premium. In a world of currency uncertainty, assets that exist outside the financial system, real estate, commodities, productive businesses, gain relative value. 6. Volatility is the new normal. The suppressed volatility era is over. Markets will swing more dramatically as old assumptions break down. This is not collapse. This is transition. A transition from a world of artificially suppressed risk to one where risk is being repriced across the board. Japan did not choose to be the catalyst, but by reaching the absolute limit of what debt monetization can achieve, it has become the warning signal that the entire system must now heed. The pin has been pulled, not because Japan wanted to shock the world, but because it no longer has the ability to hold everything together. The question is no longer whether consequences will unfold, but how quickly and how severely. For years, Japan absorbed volatility so others didn't have to. Now that volatility is escaping containment, and once it does, it doesn't move slowly or predictably. It moves through the system along the paths of leverage, exposure, and dependency that were built during years of artificial calm. The global debt bomb does not explode in one dramatic instant. It reshapes the landscape through pressure, repricing, and forced adaptation. Japan has shown that the pin has been pulled. What follows is not chaos, but consequence. And consequences, once set in motion, cannot be ignored.